We're doing this question on consolidation, the MCQs. The first question is 20.3. It says on 1st of January 2001, Jardins acquired 80% of ordinary share capital of Skimpole for 576,000. The statement of financial position on the date 31st of December is given. The non-controlling interest is shown at fair value, which is 140,000. I think it's a bit straightforward question where we talk about the purchase consideration. The total amount that has been paid is 576,000. Now this is to be reduced by net assets on acquisition date, which is share capital and retained earnings. The share capital when we acquired the business for Skimpole is 180, so we can just simply take that as it is. And for the retained earnings, we're looking at this date, which is as good as the same date as 31st of December 00, which is 108,000. This is to be reduced by the NCI, which is given at the fair value, that is 140,000, which means that we are paying 576 for something worth 148, resulting into a goodwill of 428, right? So the question 20.3 can be done like this. We don't have to give these explanations, and we just need to kind of calculate it at our end, and that should be sufficient. Okay, the next question, which is question 20.4, around the same time, it says that when you acquired 80,000 ordinary shares in Wheaton some years ago, the extracts of balance sheet of two companies on this date are given at ordinary shares and retained earnings, and on the acquisition date retained earnings were a negative of 10,000, which means that the negative 10,000 has increased to 40,000 positive, which means that in total we are talking about a gain of 50,000 since the date of acquisition, right? It says further, goodwill has been impaired by 15,000 since acquisition date. The NCI is at a fair value, which means that if I'm looking at the retained earnings schedule as per question, or let's say we'll just take another line as per question, and we have the two companies, which is V and W. We are given 90,000 and 40,000, and of course I would want to kind of adjust for since these are losses, so I'll add them both, which actually makes my post acquisition profits as 50,000, right? Now with this 50,000 we are saying that goodwill is impaired by 15,000 and the NCI is at a fair value, which actually means the impairment loss has to be borne by both the parent as well as the NCI, which reflects that my net profit is 35,000 and the parent's share will be, which is 80,000 out of 100, which means 80% stake has been acquired, which gives me 28,000. So effectively the group retained earnings are 180. Yep. Moving a bit forward, we are looking at question 21.3. It's a similar question, isn't much of a change, but now there is an adjustment for the unrealized profits. It says on 1st of April 2006, we're looking at question number 21.3. Woodwich paid 816,000 for 80% of Malta's 408,000 worth share capital. The retained earnings on that day was 476, and the retained earnings are now 1224 and 680. So the easier approach is to prepare the same schedule, that is question 21.3. Retained earnings WM as per question, which is basically on the reporting date. I'm given this 1224 and 680. I would reduce pre-acquisition profits, which is 476. Now this gives me, of course, the post-acquisition, which amounts to 204,000. Right? It says that Woolwich's inventory includes goods purchased from Malta for 18,000, and the profit is basically 20% on the cost. Right? Now there are two questions that need to be answered. First of all, who sold to whom? It is a subsidiary which is sold. So naturally the unrealized profit has to be reduced from the books of the subsidiary. Right? So what we need to do is basically identify how much is the profit. We are given the sales value is 18,000. Profit is 20% on cost, which means that cost plus profit is equal to sales, which means 100 plus 20 is equal to 120, or the profit is 20 by 120 as a proportion of sales, which means I'm looking at an unrealized profit of 18 divided by 6, or let's say multiplied by 20 divided by 120. That's 18 basically. So we are getting minus 3. That is to be reduced from subsidiaries profits precisely. Having got that, I'm looking at the net profit amounting to 201, out of which the parent share is 80%. Right? So we're going to take this value as into 0.8. So the group retained earnings will be a total value of, let's say, 1384.80, which is option B. Likewise, I'm looking at another question which is 21.6. It says Milton owns all of the share capital of Keynes. The following information is extracted from the individual companies' balance sheets, current assets and current liabilities of the respective companies. Included in Milton purchase ledger is balance in respect of Keynes of 20,000, which means that Keynes has to pay 20,000 to Milton has to pay 20,000 to Keynes, but Keynes shows a recovery of 22,000, which is basically the cash in transit figure. Now, importantly, what we need to understand in this case is in the question 21.6, current assets include group inventory but does not include group receivables in this case, of course, but does not include, or do not include, more precise, group, or let's say the cash in transit. So basically what we need to do is, from the total assets, which is, because the question is asking what is the value of the net current assets, the total assets are 500,000 plus 200,000. We will reduce this 22,000 because this is the group receivable out of the sales ledger. So minus 22,000, but We'll add that 2000 because that is a cash in transit and it's a part of the current assets, which gives us a figure of, let's say, 680,000, which becomes, okay, interestingly the figure is not given. It could be most likely a typo error, but ideally speaking, if you look at this, it should be 680,000, of course. So it's 500 plus 200 minus 22 plus 2. Okay, my apologies. I think the question talks about net current assets, so we need to obviously take care of the current liabilities also. So the way we have got this current assets, in the same manner we're going to look at the current liabilities also. Total current liabilities, it's given at 220,000 plus 90,000, but there is a group payable of 20,000 as reflected in this question. So this 20,000 would be totally eliminated, which gives us a figure of 290,000, of course, and the net current assets will be 390, which is the option that we see in front of us. That's option D. Right. Let's look at another question here. It says Rugby has a 75% subsidiary Stafford and is preparing its consolidated balance sheet on 31st of December 6. The carrying amount of non-current assets in the two companies are 260 and 80 respectively. It says on 1st of January 2006. So we need to take care of these dates. Stafford, which is the subsidiary, has transferred an item of equipment for 40,000 and it had a carrying value of 30,000, right? And a remaining life of 5 years. So the key is that an item worth 30,000 is sold for 40,000, which means that from the group's viewpoint there is a profit of 10,000 which is not earned by the group itself, right? Or it can also be said that from the group's viewpoint the value of the asset is 30,000, but in the books of Rugby it is shown at 40. And at the same time, for the entire year from 1st of January 2006 until 31st of December 2006, this asset is shown at 40,000 and depreciation is charged on 40,000. However, it should have been charged at 30,000. So considering all these things, we are looking at, let's say, question 20.9. We are saying that non-current assets are 260,000 plus 80,000 minus 10,000, which is the gain, but added by the excess depreciation of 2,000, because on that profit of 10,000 there must have been an extra depreciation charged by the parent company, which gives me a value of, let's say, 332,000 as an option B. Are you okay with that? Yep. So there is another question which talks about a scenario. It says Tom has purchased all the share capital of Jerry during the year. Which of the following items would Tom take into account while calculating the fair value of net assets? Now the key is that we're talking about the net assets on the date of acquisition, which means that if Jerry has, let's say, a contingent liability, naturally its fair value has to be taken. A provision required to cover cost of reorganizing Jerry's department to fit within the Tom structure. Now this is something which is expected to happen later, right? So the parent will make some adjustments later, which is nothing to do as far as the value of the business is concerned, right? Finally, we're talking about the warranty provisions in Jerry's books to cover cost of the commitments made to customers. This is certainly a committed liability or a confirmed liability in the books of Jerry. So both A and, sorry, 1 and 3 are correct, which means that the option C is the correct entry, and this would be the answer for the purposes of this particular question, right?